With the surge in global commodity prices, global central banks, including the RBI, have turned hawkish to tame inflation. Thus, analysts expect volatility to be the new normal for equity markets. Frontline indices Nifty 50 and S&P BSE Sensex have tanked 4% each so far this year amid a triple whammy of rising interest rates, inflation, and geopolitical tensions. With the RBI joining hands with global majors in pivoting policy towards inflation control, analysts expect the central bank to aggressively increase rates in 2022 to drain liquidity out of the system. Hence, the question revolves around how investors should design their portfolio in a rising interest regime. According to A.K. Prabhakar of IDBI Capital, banks and life insurance companies could be the safer bet amid the rate hike regime.
Banks also will benefit because it is a rate cycle reversal. Now, we were in a reducing cycle. Now we are in an increasing cycle. Normally, loan rates will rise faster than the deposit rate. No, because people normally don't premature and then 100% doesn't happen. But in loan rate, the rate transformation will happen very fast. No, because the clause is there. No, like life insurance in that space. Where that is one sector. Where I think. It can benefit from the rising interest rate. It can increase their margins also. Rising interest rate is never good for credit. Industries which are growing on credit, mainly in real estate space, where the amount is very big. See, at least consumer durable, the amount is very less, and people will not feel the pinch. But in reality, it will be known very soon. And the demand might taper off. We have seen very good demand. Even in April, the amount of registration which has happened in Mumbai is one of the highest ever. So there it will have an impact. Real estate will have the maximum negative impact due to rate hikes.
On the flip side, analysts expect rising interest rates to dampen capital-intensive companies with heavy debt on books.
We are in a rising rate environment. The banks and all these NBFCs have been able to improve their margins also. So even if the cost of capital goes up by say X%, they are able to pass on more than X to their customers. And that's why it's not necessarily that the banks or NBFCs will do well. In fact, I would like to think it in a way that since the economy is strong enough, there should be more credit growth and banks should be able to deploy their capital profitability even if there is an environment, rising interest rate environment. So personally, we are not very bearish on the markets from these levels and asking people to invest in financials. And other than that, obviously the regular sectors like refineries, we have been bullish. So we have asked people to look at that, and IT stocks have also corrected. So that's where one should focus. Consumption post-June, we are expecting like the Met and other forecasting agencies have already announced that it's going to be a normal monsoon. So post-June, July, I'm expecting a rebound in rural consumption. And at that time, post that, we'll look at the consumer names, not now. I think they are into correction and we would like for better prices to come. Auto, we are not that bullish on that sector. So there is a lot of competition, disruption from the newer technology and new startup players in two-wheeler side. On four-wheeler side, when there was a lot of demand, they had supply issues. And then now, due to higher prices, because of the metal and other inputs, the demand is not that much high.
Overall, investors may look to add financials and IT to their portfolio, while debt-heavy capital goods stocks may be avoided in these times. Meanwhile, Friday's trading session will largely focus on stock-specific action amid Q4 results season and global trends. Index heavyweight Reliance Industries is set to announce its March report card today amid expectations of a somber sequential earnings growth. Analysts expect the Mukesh Ambani-led conglomerate to report consolidated net sales and EBITDA growth of up to 52% and 35% year-on-year and up to 22% and 6% quarter-on-quarter. Furthermore, the net profit growth is pegged in the range of 18 to 28% year-on-year, but down up to 16% quarter-on-quarter. Among key monitorables, analysts will eye management's commentary on benefits from higher fuel margins and crude sourcing strategy, comments on the impact of higher petrochem prices on domestic demand, and signs of reversal in telecom subscriber churn. In the primary market, investor participation in the mega LIC IPO on its third day will be on the radar after the issue sailed through on day 2.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.